Welcome to today's What Moved the Market show. I'm your host Prem. It's Monday, February 2nd, 2026, and here is everything you need to know as the markets close for today. Indian equity benchmark staged a remarkable recovery today, rebounding strongly from yesterday's budget day sell-off. The Sensex surged 944 points to close at 81,666, while the Nifty 50 advanced 263 points to settle at 25,088. This 1.17% gain on the Sensex and a 1.06% jump on the Nifty represent a powerful comeback, as institutional buyers re-evaluated the budget proposals and shifted focus from short-term tax concerns to long-term growth tailwinds. The market opened lower this morning, tracking weak Asian cues after precious metals collapsed overnight, but aggressive buying interest kicked in during the afternoon session, pushing indices near the day's highs as the closing bell rang. The rupee traded at 91.39 against the dollar as we closed, recovering slightly from its recent weakness amid easing geopolitical tensions and shifting capital flows. The broader picture is one of volatility and repricing, but the rebound today shows that value hunters have returned. Bank Nifty climbed 200 points to close at 58,619, maintaining solid support as private banking counters led gains across the financial sector. The Nifty mid-cap added almost 1%, while the small-cap index gained 0.6%, indicating that broader market participation is returning despite the FII selling we saw over the past 2 days. Power Grid Corporation was the standout star of the day, surging nearly 8% after raising its FY26 capex guidance from 28,000 crore to 32,000 crore, signaling strong infrastructure investments ahead. Campus Activewear jumped nearly 7% on impressive Q3 earnings, with profit soaring 37% to 63.7 crore, and revenue climbing 14% year-on-year to 588.6 crore. UPL was another big winner, rising more than 5% as the agrochemical company reported a strong 12% revenue growth to 12,269 crore in Q3, beating expectations, while EBITDA grew 13% to 2,433 crore. Adani Ports, SEZ and Larsen & Toubro also featured prominently, gaining above 2% as infrastructure and capital goods stories benefited from the budget's enhanced capex push. On the flip side, Shriram Finance led the losers with a 3% decline, reflecting broader concerns in the financial sector despite bank strength. Max Healthcare fell nearly 3%, Infosys dropped 1.6%, and Cipla declined 1.71%, as IT and healthcare sectors faced mild headwinds despite some long-term policy tailwinds for tech. Axis Bank also softened, down 0.59%, amid borrowing concerns from the government's elevated fiscal spending projections. Technically, the Nifty formed a strong bullish candle with a lower shadow, holding the critical 50,000 mark. Immediate resistance for the index is now placed at 25,200, while the key support sits at 24,900. If Nifty breaks below this support, the next demand zone emerges around 24,500. Bank Nifty is trading near its 900-meter moving average and shows immediate resistance at 58,900, with solid support around 58,250. Both indices closed decisively above their intraday lows, suggesting the bulls are reasserting control after yesterday's panic selling. Sector-wise, the market showed a clear dichotomy today. Auto, infrastructure, metals and FMCG sectors led the rally, gaining 1 to 2.3% as the budget's emphasis on defense spending, infrastructure guarantees and rural employment resonated strongly. PSU banks also rallied, driven by increased defense capital allocation and infrastructure focus. However, IT and healthcare sectors remain under pressure, declining mildly even as the budget extended favorable long-term tax incentives for cloud services and data centers. The overall breadth remained neutral with roughly equal gainers and losers, indicating a selective market where quality infrastructure and domestic consumption names are being preferred. The finance minister's budget announcement of higher securities transaction tax on derivatives, rising to 0.05% on futures and 0.15% on options, effective April 1st, continued to weigh on market sentiment. However, the market's focus gradually shifted to the positives, including a record defense allocation of 7.85 lakh crore, with an 18% jump in capital procurement, strong railway and power spending, and new incentives for data center investments. FII flows remain negative with institutional investors continuing to net sell, having offloaded nearly 683 crore through DIIs and 588 crore through FIIs by yesterday. This selling pressure has kept volatility elevated, with the India VIX trading near 15.1, up over 12% from previous levels. The broader sentiment suggests a market reassessing valuations and repositioning after significant moves. Commodity markets experienced significant volatility today. Crude oil prices fell sharply by around 4.9% to $62 per barrel, as easing tensions between the United States and Iran reduced supply disruption fears, and OPEC Plus reaffirmed plans to keep production steady. Domestically, crude fell 5.79% to $5,666 per barrel. Gold prices on MCX continued their decline, trading near 1,46,000 per 10 grams as the precious metal sell-off persisted amid higher margin requirements from CME and profit booking following the nomination of Kevin Walsh for the Federal Reserve Chair. Silver prices on MCX fell sharply, settling around 3,331,000 per kilogram, as the white metal extended last week's dramatic decline from record highs. The combined weakness in precious metals reflects shifting investor sentiment away from safe haven assets and towards equities as geopolitical risks ease. Global geopolitical developments provided crucial context for today's market action. Easing tensions between the United States and Iran bolstered risk sentiment, with comments from President Donald Trump suggesting serious negotiations with Tehran, reducing immediate supply disruption concerns. This de-escalation, combined with steady OPEC Plus production decisions, helped ease energy prices and lifted investor confidence. Asian markets initially faltered due to the precious metals collapse, but Indian equities managed a strong recovery as domestic policy tailwinds took center stage. European markets remained flat, with commodity-linked losses offset by consumer staples gains, painting a picture of cautious global sentiment despite improving geopolitical outlooks. Looking ahead to tomorrow, the Nifty needs to hold above 24,900 to maintain the bullish narrative. A break above 25,200 would open the path to 25,340, where fresh resistance emerges. The key scenario to watch is whether sustained buying interest continues or if profit-taking emerges at these levels. Bank Nifty faces the same critical decision point, with 58,900 as the next hurdle and 58,250 as the immediate support. Traders should monitor how the index closes tomorrow relative to these levels, as a sustained break above 58,900 would confirm the reversal. Given the elevated volatility and mixed institutional flows, expect continued range-bound action with sharp intraday swings until a clear directional bias re-establishes. Global cues tomorrow, particularly any movements in crude oil, precious metals or fresh geopolitical developments, could trigger sharp repricing. Here's the key takeaway as you plan your trades for tomorrow. The budget has sown seeds for long-term growth, particularly in defense, infrastructure, and manufacturing. But the near-term volatility from STT changes and elevated government borrowing will keep markets choppy. The recovery today was driven by value buying in infrastructure, power, and defense plays, so a continued focus on these theme-driven counters may offer better risk-reward than chasing broad market rallies. Set your stops at 24,900 on Nifty, and use any intraday dips towards this level as potential entry points for small positions, with a target of 25,200 to 25,340. On Bank Nifty, the same discipline applies. Support at 58,250 is your hard stop. If you have questions about today's market moves, specific stocks, or technical levels, please send them our way and we'll address them on tomorrow's show. Stay tuned for morning wrap coverage, and remember to keep your risk management tight given the volatility. Thanks for tuning in to What Moved the Market, and I'll see you tomorrow.